If I'm a buyer in today's market, what can I expect in terms of like rates for a conventional loan?
If there's a red flag, that's a showstopper where that could prevent that deal from going forward unless another solution is presented.
What do we think happens the next 6 months of 2025 and into 2026?
When you go to these jumbo loans, there's no PMI. So what the investor does to compensate for the risk that they're taking is they will give a higher interest rate.
Does it mean when they cut rate that the mortgage rates are going to go down? Let's move to condos.
Condos,
which is much more interesting, much more complicated.
Action-packed.
Exactly.
Yeah.
So condos.
Yeah.
What are the hurdles in condos right now? Because there's a lot. Not easy. Okay, I guess let's start with condos built post 2000.
Yeah.
Which is mostly what I sell personally.
Right.
I sell the newer condos.
Yep.
I try to steer away from older condos.
Okay.
Not only because they have a lot of their own issues, but also getting a loan in older condos is very complicated. Mm-hmm. So let's start like a 2010 condo.
Yeah.
What's the difference between getting a loan in a condo post 2000 and a home?
So with a single family house, there's less red tape. With the condo, we have to get the borrower formally approved, and we have to get that condo project formally approved.
The building has to get approved.
The building has to get approved.
So even if the borrower is like the perfect borrower,
yes,
perfect credit score, great income, no debt, if the building doesn't qualify,
yes, if there's a red flag, that's a showstopper where that could prevent that deal from going forward unless another solution is presented.
So in the, let's say post 2000 buildings,
yep,
what are the red flags that we look for?
So we will submit a condo questionnaire to obviously perform due diligence on what's going on with the project, but we look for things where no single investor owns more than 20% of the units. We look for, we want to see that a majority of the projects over 50% are owner occupied.
So if it's too investor heavy, let's say 60% of the building is owners that rent out the property.
Yes.
Won't qualify.
Well, not necessarily. So if an investor is trying to purchase that and it's over 50% are being rented out or leased out, that would prevent them securing a conventional because that is increasing the population of investors that are in that building. If you're owner occupied, and let's say even if it's over 50% that are investors, the fact that you're going to live in the property, that helps. It really matters if you're an investor trying to buy. But if you're an owner and you're going to deplete the percentage of investors, then obviously that could be a good
so that
sign.
comes into play if you're an investor, also an investor.
Yeah.
But if you're an end user, it doesn't really affect you too much.
Yes.
Okay, so what are the other red flags?
So the other things that we look for is pending litigation is a big deal.
Which is a huge one in post-2000 built properties because a lot of them, these buildings get delivered. Once the developer transfers the ownership to the homeowners association, they realize maybe like a year or two, like, hey, this is not done up to par, this is not working, and then there's a lawsuit that comes towards the developer.
Right. And we see a lot of that.
That then complicates loans, financing.
Correct, because when we see a pending litigation and we see it might be against a developer, our main concern is just making sure there's no safety structural issues.
Yeah.
So when we look at these inspection reports and there's things where there could be cracks in the foundation that are being addressed, the pool, there could be a number of different things, the parking lot. So we dive into what is basically the issue. Does it impact the safety structure of the project? More importantly, if the HOA is named a defendant, we want to make sure that the lawsuit will not bankrupt the HOA too. So we typically require some type of opinion from the HOA's insurance company that their coverage basically is enough in case they lose the lawsuit though too as well.
That's if the homeowners are getting sued.
Yes, that's correct.
Most of the time, it's a homeowner suing.
It's usually the other way, correct, around.
But there could be like a single owner suing the homeowners.
Yes, correct.
The building.
Yes, correct. So then the other thing in terms of the condo project is we're seeing a lot of assessments right now, right? I don't have to tell you. Everything's getting
especially in the older buildings, which we'll get to.
Yeah, we'll get to. Yeah, okay.
But like post 2000s.
Yeah.
It's really the main hurdle, I guess, is the litigations that we see.
Yep.
I guess the rent-to-own ratio if you're an investor.
Yeah.
Do you need a larger down payment on a condo?
So typically,
if I'm like, let's say building qualifies.
Yeah.
And let's say I'm a conventional buyer.
If you're a conventional buyer and that project passes a full review, which means that it's warrantable, you could put down as a first-time home buyer as low as 3% in that condo. But if it passes a full review.
Okay, and what's the percentage of condos that we see passes the full review?
They're few and far between.
5%?
Yeah.
I mean,
there are projects there. There are projects that are there.
Yeah, two midtowns to take.
Yeah, exactly.
Quantum,
those that are properly managed. But these other two components that we have yet to address, though, also is these assessments are coming up as a result of not reflecting 10% reserves in their budget sometimes. So we do look at their financials as well to ensure that if there's major capital expenditures, that they can cover it in their budget. A lot of projects that we've seen prior to 2010, they don't have the budget. They don't have those reserves there. So they're hitting all these condo owners with the assessments, which is why you're kind of seeing.
Because now the reserves are required.
Yes.
By law.
Yes.
You touched on reserves. The reserves are part of passing that full qualification of the building, correct? Having the 10% reserves.
Yeah, it's that, and again, it's also required. I mean, you can probably talk about more about the recertifications for the 50-year and all that stuff. But I mean, I'm sure that that's one of the requirements, that they have funds to basically get that building up to standard to pass those inspections, though, too, as well.
Let's say I'm a buyer.
Yeah.
Going back to the scenario.
Yeah.
Because the scenario that I'm a buyer, conventional buyer, and then the building qualifies, great. I could do as low as 3% down just as a home. But let's do to the more common, what we see.
Yeah.
I'm a buyer. The building is not fully qualified.
Yeah.
But there's not like a huge issue like a litigation, something like that. So I could still technically get a loan on it.
Yes.
What's my down payment requirement? 20%?
You could do as low as 10%.
Okay.
Okay. Let's say it just passes, most of the
partial review, I guess.
The review, and they don't have 10% reserves, but they might have a reserve study, right? So that's say, hey, we're not quite there, but we know what measures we need to take to get there, and we'll review that during due diligence and say, okay, this project can get there. Okay, well, we can make an exception to it. But if it's less than 10% reserves, it's going to require 10% loan. A 10% down payment to do that. And not to add a layer of complexity, Fannie Mae will only lend up to 75% on the first loan, as the first trust for that mortgage. They will not basically extend any more credit past that. So what you could do is with 10%, you basically get a second loan or a home equity line of credit, and on top of the 75%. So you're getting basically a 15% second. So that complicates things because some lenders don't offer this second home equity line of credit. You might have to go to a bank and get it, and you know what I mean? So you have more moving parts. It complicates the issue more. The deal, right, when the condo doesn't have the 10% reserve.
Which is why, like, if let's say you just do 25% down, problem solved.
Yeah, you can do it, right? You can do that.
But so that's if someone has the means,
Yeah, but that's for a primary residence, right?
Right.
So if you go and invest, you're an investor's going there, that's 30%.
Right.
It's the max 70%. So it varies by occupancy type. And the last thing that I would say that I am running into more than anything now in Miami is the insurance. So we always look at the master insurance policy, and we want to make sure the deductibles meet the minimum requirements that Fannie Mae will allow, and that's typically 5%. So, we're seeing policies that have higher deductibles because it's a cheaper option for the HOA, because if you have to pay more,
but then it affects the financing?
Then it impacts the financing, because if it's over 5%, that disqualifies it from Fannie. So then now you're going from a warrantable project now to an unwarrantable project, where now we're in a whole nother ball game in terms of what financing in unwarrantable condos.
So let's say the condo's unwarrantable in the insurance purpose that you mentioned, or there's a litigation.
Yeah.
What's my way of buying there if I really want to buy something in that building?
So number one is just kind of resetting expectations that the rate terms, it's a higher credit risk because the property type is now a higher credit risk, right? There's obviously some red flags that are here that will not be purchased by Fannie and Freddie. So now we have to go to these unwarrantable, and then you get into what's called non-qualified mortgage, which is unconventional, like you brought up earlier, which it's not as liquid. So only an investor will purchase and keep that loan. So their guidelines are going to be a lot tighter. Yes, they will make exceptions for insurance higher than 5%. Yes, they'll make exceptions for a single investor that owns more than 20% of the units. So each project is unique. It's just finding an investor that will purchase and service that loan.
And typically that would mean higher down payment for the buyer.
Yes.
Higher interest rate.
Yes.
What else?
Those are
the main two.
Those are the main two, and that's where, and I see that a lot of times buyers, when they had these conventional terms that they were locked in, they thought everything was great, and then when you pivot to these higher rate terms, that's kind of where that trying to manage through that to keep that deal together.
Yeah.
And that's where buyers can really leverage the sellers and the listing agent to kind of either kind of renegotiate the deal or reposition the contract, because the project's not up to basically up to
and when I'm representing buyers, for example, and like all buyers, they're shopping online,
right,
which I think is great.
Yeah.
But they'll send me, hey, I like this condo. What do you think about it? Let's
Right.
go see it. It's our job to know what's going on with that building.
Yeah.
So I'll say, hey, that building's in a lawsuit.
Right.
Getting a loan will be, very difficult.
Yeah.
Especially if it's like a rate-sensitive buyer. Mm-hmm. I'll say, you're going to have to pay a larger down payment. You're going to have a bigger interest rate.
Right.
So like, unless if you really want to go see it,
Yeah.
let's not even waste our time.
Correct.
And then either they say, no, let's go see it, or anyways, I'm fine with it, or, okay, actually, most of the time say, no, I don't want to get into that mess.
Right.
So it's important to know what's going on in the market, in the buildings.
Yeah.
And this is all newer buildings that we're talking about.
Right.
If we go into the older buildings, like let's say we're in Miami Beach and we're talking 1950s condos, 1960s condos, 1970s. They carry everything that we just discussed, which is already a lot.
Right.
Plus the factor of like huge special assessments coming.
Right.
Because now we have to go to 40-year, 50-year, 60-year, 70-year recertifications. Mm-hmm. And a lot of those buildings have been neglected for forever.
Right. Not maintained.
Not maintained.
Yep.
So Surfside collapse, such a horrible thing.
Right.
But it's actually going to be better for the long run of like these condos, because now there's no way they could let it happen again.
Yep.
So now all these older buildings that are kind of like getting run down.
Yeah.
Now they're doing the structural integrity, like you mentioned.
Right.
So they're resurfacing all the all the concrete, redoing the pool deck, redoing the parking garage. Everything's getting done.
Yeah.
But it's leading to a lot of problems also.
Right.
Not only loans, but like for the people who live there, because let's say there's someone that owns a condo that's worth $350,000.
Yeah.
They get hit with an assessment that's $250,000.
Right.
It's like, how am I supposed to pay for this?
Right.
So.
And I like where you're going with that, because the other thing that a buyer needs to understand is when you're going in there, we're not doing the due diligence to be a pain in the rear, right? We want to make sure that the condo project is good, but we're also doing on behalf of the buyer though too, from a remarketability standpoint. I mean, if you're buying, you want to know that the next, when you resell that thing, that they can get a loan and won't have any issues and have to go through this unwarrantable outlet
100%.
Where it's the guidelines are a lot more.
It affects your investment.
Exactly. So you have a vested interest
to
take your advice, right, to make sure to get your guidance on which projects are good and which ones aren't. But
even cash buyers, I tell them, like, hey, this there's issues in this building.
Yeah.
There's lawsuits. I know you're buying cash, so it doesn't matter if you get a loan or not.
Right.
But if you want to sell this in 2 years, 3 years, 4 years, if you're not sure you're not going to be here long term, like, it could be an issue reselling to a standard buyer,
right,
which will affect you. You know.
Well,
so
that buyer
important.
could also implement the change, though. They could get on the board. They can help manage, right, and make sure things are in order in terms of shoring up reserves, right, making sure the litigation's being resolved in a timely manner, just making sure it's just everything is managed correctly to meet inspection guidelines, so that it's going to be marketable and not lose value from being unwarrantable, because it's going to be harder to sell and you have longer days on market, you know what I mean? So it's harder to resell it.
So to wrap up the condos, I guess the key points are a lot more due diligence.
Yes.
The borrower's situation is the same.
Right.
But a lot more due diligence on the property itself.
Right.
It's not impossible, but it's definitely important to know which building you're getting into, which building you're getting into bed with.
Right.
And really you want to know kind of the situation before. Like it's our job to advise, my job as a real estate broker to advise my clients like, hey, this is going to be a headache, let's not bother. Or this building is great building, great reserves, great financials. This is a great building to invest in. You can buy it with 5% down, whatever. Yeah, I mean, condos in general are just a little bit more difficult, not impossible by any means.
Right.
A lot of my sales are condos. A lot of what we've done has been condos. So we've definitely have done a lot of them, but it's just more complexity.
More complex, and I think it's highly critical to work with somebody who understands condos, the ins and outs though too as well, right? It's not, we just talked about the differences. It is not a single family home, like, put the loan application, let it ride and think that, and how often has it happened to you that those condo questioners don't come back until the week before closing and then you find out there's an issue and then you gotta...
You've been in contract for 40 days.
Yeah, exactly, right?
And then now there's now there's no way to close.
Right.
Now you have an upset buyer and an upset seller.
Yeah.
So regardless what side you're representing as the broker, it's a bad situation.
Right.
And personally, as the broker, and I guarantee you for the buyers and the sellers and a mortgage broker,
right,
we want to know that before going into it to not waste our time.
100%. And that's the thing is, our time is important, so we don't want to waste their time. Obviously, they don't want to waste our time. So that due diligence is performed. Ordering that condo questionnaire immediately is highly critical because, sometimes in Miami, you got people operating on island time that they could take 14 days to get it back. We won't get it back to the 14th day. But you can see the
island time.
you can see the timeline though. Like if you wait and they wait 30 days, that's how you're at 40 days, right? And you're finding out the week before closing. So as a lender, it's important for us to put the buyer and your interest, right, to make sure that we do everything within the financing contingency to find out and just vet out that if there's going to be any issues so that we could get to the bottom and provide a solution.
Let's talk foreign nationals.
Okay.
I've dealt with a lot of foreign nationals. I know you deal with a lot of foreign nationals, whether from Europe, South America. Truthfully, a lot of